Hi, it's Michael Kerr here, presenting Small Business Banter. Welcome to the Small Business Banter podcast. I'm Michael Kerr, your host, and I'm also the founder of Kerr Capital, where I work day to day with business owners. The Small Business Banter podcast is built just for business owners and will be especially relevant if you're an owner looking to sell, if you've been unexpectedly approached by a potential buyer, or if you're an aspiring owner about to buy a new business. There's a lot on the line personally and financially. It's stressful, it's emotional, and it's usually new territory. So to help, each episode of Small Business Banter is a discussion between me and another business owner or an experienced small business advisor. We talk about their experiences. So what you'll get is practical, real-life advice, different takes on everyday problems, and a renewed confidence to tackle your own business challenges. Good morning and welcome into edition 139 of the Small Business Banter podcast. Martin Cattach joins me today. Thanks for coming in, Martin.
Oh, thank you for inviting me, Michael. It's a pleasure.
Martin, for those listening, Martin's who you call when the banks say no. I think your tagline is "Call me when the banks say no," which prompted me to reach out and chat to you. You're the founder of Finance for Business, a working capital strategist for small and medium businesses. You've had prior to that a fairly diverse career. Again, big thanks for joining today. A really relevant discussion for small business owners for reasons that we're going to talk about the stranglehold of the Big Four have had on business lending to small business over the years. So we'll also touch on some of the options available to small business owners today outside of the Big Four. We're going to talk a little bit about how to prepare better for getting any finance, really. It's often the lifeline of a small business. And maybe some of your experiences and examples of some of the clients you work with to help them grow their business. So, Martin, do you want to just give us a couple of minutes on your background, where you came from, what the core business is today?
Right. Yeah, no, more than happy to. I was sitting down preparing for this and I thought I've actually spent 20 years in finance. And 10 years of that was at the beginning of my career, so from about 22 to 32. And the last 10 years I have spent in finance, and in between I did a couple of interesting things. I worked in a number of different industries: communications, IT, and social and policy research for government. So it's quite diverse, but I suppose I'm always been orientated towards the sales and marketing end of the business. And the diversity of things that I've done in my past gives me a great understanding of the issues that small business face. And of course, I run a small business right now myself, which is Finance for Business. So it puts you in touch with a lot of things. I suppose something that goes back a little bit earlier than that is interesting is that I grew up in hotels, which turned
family-run hotels. Yeah.
Yes, family-run hotels, which is basically gives you a great cross-section of society to deal with. And I started working in a public bar when I was 14 years of age. So, I've
in colourful old Fitzroy, wasn't it?
Yes, it was in colourful old Fitzroy. So, if anyone knows a little bit of the Australian gangster history, the hotel we were in was actually where the famous Squizzy Taylor, who was a gangster in Fitzroy some time ago, and they actually launched his book in that hotel some time ago as well. So it was a bit of a notorious site. Unfortunately, it is now closed and has been taken over by St Vincent's and is now a renal unit. But Fitzroy at the time, I think, had more hotels than any other suburb in Melbourne, and it's one of the smallest. So there's a hotel on every corner in Fitzroy.
Yeah, there are some great old hotels in there. It's heartland stuff, isn't it? And some of the hotels have actually preserved pretty well what what they might have been, 50 years ago. It look and feel. So, as you say, that's a great foray into a business and a career advising small business owners. You've worked across those different sectors. You grew up in a family business, and the small business community in Australia is very, very diverse. And so, you're going to be talking to all sorts of different business owners about different sorts of challenges. So you can kind of perhaps see it from a few different perspectives, or from their perspective, even if it's a fairly unique business. Can I just set the scene a little bit with how you see the current? We have been. I think we still pretty much are dominated by big four banks when it comes to small business lending. What's the state of play as you see it?
Well, there's been a lot of change in the last 10 years in what's available to small business in lending. The banks are still the dominant player, and in the majority of cases, they're the cheapest. And the reason they are the cheapest is that the banks do most of their loans, or 99.9% of them, secured. And
by a residential property mostly?
Yeah, and a lot of people don't realise that the banks use a document called an all monies mortgage. So, for example, if you have a mortgage with, let's use NAB as an example, and your business banks with NAB, and you have an overdraft with NAB that you might have done rather quickly, might only be a small overdraft, but it is in fact secured against your residential property. And people don't actually realise that those two things are linked. So what the banks have traditionally done is they have locked a client up. So once you're with a bank, all right, they've got your house, they're possibly funding your investment property as well. And the situation is that you've got a single supplier source, which is a risk in any business, because if the bank changes its mind, and if I look at the current environment now, and I do a lot of work in the construction industry, but particularly in the residential construction industry, is considered by most of the banks don't touch. We've seen a lot of big failures in that area, and there's a lot of small builders that have fallen over as well. What do you do if you're a builder and you've survived the current problems? Your bank is going to be of no help to you because you've got a single source of supply. You don't have a diversified range of borrowing in your business. You're sort of put all your eggs in one basket, to use the investment type statement. No one would invest in just one.
Yeah. So I did understand there was almost to classify that lending as either residential or business. There was, I think, a lot of it was buried in as residential lending at some points. But so one way or the other, it's cheaper. It's probably easier because you don't need to necessarily dig too deep on the business if you've got plenty of coverage on the residential property security.
Oh, that was the case once, but they tend to look very deeply at the moment. They're incredibly risk averse across all small businesses because we're in an economy that's tightening at the moment. And, I've mentioned builders and construction related, which is a big part of the Australian economy, but also I've seen that they are not very helpful to those in the retail industry either. At the moment, which are under pressure. So I often use the expression that banks are fair weather friends.
Fair weather friends.
Yes.
Yeah. And so they are, but they are undertaking their analysis of a credit in a way we might expect anyway, which is to look at the business first. Is that what you're saying? Even and setting aside for a moment that there is security, they're going back to like a primary analysis of the business.
Yes, they're looking at the business, and they have a big advantage because a lot of funding and that is not so much based on financials these days. Here's my profit and loss and balance sheet. Mm-hmm. If you're a banker or the new fintechs, everybody wants read-only access to your trading account.
Yeah,
because
the source.
Yes, no matter what the financials say, If we look in real time at transactions through the bank, then we have a good idea and we can run analytics software across those transactions and make some decisions about how creditworthy they are, what's their trading position and their liquidity.
Yeah, okay. Yeah, so it's unfettered, unadjusted real data, isn't it? What goes through your bank account day in, day out.
There's but you've got to see from the banks where they see industries and get early warnings. They have enormous data warehouses. When you consider the size, let's take someone like NAB or Commonwealth Bank, they would have 500,000 small business customers, possibly 1 million, and they have that real-time data and they see trends and trading situations all the time. So armed with that data, that's where they tend to be a bit awkward at times.
I think what you're saying is that with that large bank of data, if each of the banks have such a significant number of small business customers, they're able to really dig deeper and look at industry by industry. Then they can take a view that construction or retail isn't a particularly attractive industry for them. So there's forces at work there. Either if you're a part of that industry, you it's going to find it really, really tough. In terms of from an owner's perspective, given this, what you've just talked about, still strong control dominance by the Big Four, what should an owner be thinking about doing to untangle themselves if they're completely tangled up? And what are their options outside of the Big Four banks, and what do they do to better prepare themselves?
Well, there are now quite a number of options outside the Big Four banks, and let's talk about detangling. I apply a methodology I call better business banking, which is basically to diversify and not go single source, which is what happens when you're tied into the bank. So, for example, let's take generally the owner's residential property has some sort of mortgage on it. You can replace that mortgage with a non-bank mortgage or from a different bank than where you actually do your business banking. So we can keep our personal and business assets separated, and that's one thing you can do. And there are also, the banks have, in order to manage their risk and diversify their own portfolios, they are often the funders and the partial owners of most of the new fintech companies. So, but what the fintech does is it takes it away from the bank's policies and puts it into a higher risk category, which generally means that it also has a higher rate, but it's easy to get. So, in finance, there's always this rate for risk type calculation. And then as a business owner, you've got to look at what your ROI is going to be. There are some terribly good unsecured overdraft products in the market at the moment that you can apply for and have granted in 24, 48 hours. Except the only problem with these products, it's no problem getting 100,000 or even 200,000, is that the rates are between 19 and 22%. But I suggest to businesses that they look at applying for one of these overdrafts and keep that as a cash reserve. You only pay when you draw down the funds. And because it's an overdraft, you can reduce the cost of those funds by paying it back. But when opportunities arise, and for simplicity, let's use 18% as the number. Well, that's 1.5% a month. So if I can buy, perhaps my competitor is falling over next to me, and I could buy all his stock at a fire sale value, well then paying 1.5% a month to grab that stock at 50% or 25% of its value is a simple business decision.
Yeah. And look, this is, it's the nature of a lot of small businesses to be, for want of a better term, hustling. And if you can see an opportunity, grab it. I think one of the things you're kind of saying there is that they are expensive, but if you look at the return, it may well be worth it. I think it's also potentially the right thing to. There's this idea of having credit. You had said having a credit facility there, applying when you're in perhaps a strong position, even if you don't need a facility there and then. Is that a part of being ready for opportunities?
Yeah, I think being ready for opportunities in a dynamically changing market and somewhat of a downturn that we are now, I stress to my clients, look, get one of these unsecured overdrafts. The holding cost per year, if you don't use it, is like $495.
Yeah.
So, to have $100,000 available in your back pocket, because one of the advantages that a small business has is they can be very nimble.
Yeah.
And if you're going to be nimble, you need liquidity or to have some cash available to exercise that, because that way you can take opportunities, and that's what small business is very good at, is taking opportunities and turning them into profitable ones.
Hi there, it's just a quick interruption to the podcast, and it's a message from Kerr Capital, a supporter of the podcast. If you're a business owner thinking about selling and you're unsure about what you should do, well, the worst thing you can do is jump straight into an unprepared business sale. Cross your fingers and hope for the best. If you want to take control, get a sense of what your business is really worth and a plan to make it more sellable, then head over onto the Kerr Capital website, check out the value and sellability diagnostic. If it piques your interest, contact me, Michael Kerr, or book one of the free 45-minute diagnostic calls. Now let's head back to the podcast. I also just want to go back a little bit to that detangling thing. One of the barriers when you are entangled like that, and not just from a lending and a security perspective, but from if your core operating account is with the same institution and you have direct debits and you have payments, coming in, and it's a real pain. It's non-trivial to set up another operating account with all of connection with your software, accounting software, and so is that often a barrier just because it can look just too complicated, too hard?
Look, it can be a little complex, but the idea is how I would detangle in the majority of situations is we wouldn't change banks where we have our trading account. Tend to leave that because, there's a bank on every corner, or there was some time ago. Now there's not many of them that our branch presence. But, whether you bank ANZ, Westpac, NAB or Commonwealth doesn't really make a great deal of difference. And if you've got that set up a trading account and that's all working, it's the other things that the bank has that need to be detangled. So it might be that you put the residential property somewhere else because it's a very competitive market there, and there are non-bank lenders that are as cheap or cheaper than the banks. So you can look at decoupling the residential property from the business, and depending on what your business borrowings are, particularly if you're planning to sell your business, which I know a lot of your listeners are looking at that as a long-term strategy. Well, you want to try and make it as clean and as easy to do that and unlock from the bank or begin that process as you begin getting the business ready for sale. Yeah, no,
it's and I think one of the other things leading into it, planning a sale is you need to keep your foot on the accelerator, and you need to keep chasing opportunities, and those if there's an opportunity to acquire stock, as you say, from a competitor that's failing, or these opportunistic. They're not completely opportunistic, but you're always on the lookout for where can I generate another sale or another relationship. And that's so important as well. That going into a sale, your business has momentum, and you can point to where the growth opportunities are and capture some of them. So not having one of those facilities, might actually also be a detriment from the point of view of just not capitalising on revenue potential.
Yeah, that's very much the case. And a business, if you want to sell it, my experience is it's got to be growth, and you have to fund growth. See, one of the problems, and coming back to why I use the term working capital strategist, is that people are consistently talking about they have cash flow problems. the term cash flow is often overused. They don't really have a cash flow problem. They have a lack of working capital problem. And a way to illustrate this is let's use these numbers because it makes it nice and simple to work with. Let's say the business has a $1.2 million turnover. It's $100,000 a month. So that's pretty simple to work out. Now, any business that has that sort of turnover is going to have debtors, people, the way we fund our customers, because unfortunately one of the things you have to do in business is you provide credit terms to your customers, just as your suppliers provide credit terms to you.
Yeah.
And so let's say we've got that $100,000 a month. Well, generally, any business that is trading and rolling along well normally has about 2 months' worth of debtors on its book. So let's say we've got 2 months' worth of sales. So that means we've got $200,000 owed to us. And just to make it simple, my suppliers, because I add 50% value to it, my suppliers owe them $100K. So at any given time, I've got terms where I need $100,000 in the business. My suppliers are carrying $100,000, but I'm taking $200,000 worth of customers, so I need $100,000 working capital. And people think it's cash flow because they're waiting desperately for someone to pay them or trying to bring their terms in early, which is just that they don't have enough liquidity in the business. And this becomes acute when the business grows, because if I turn around and double the business size, so it's gone from 1.2 to $2.4 million for a turnover, I've got $200,000 that I can get from my suppliers. My customers owe me $400,000. So I now need $200,000 to run my business. If I do anything before I can trade or do anything. So that's where this working capital and having enough liquidity in the business is crucial for growth.
Yeah. It's a very misunderstood. I think just about every small business owner I've ever dealt with does understand cash in, cash out. But, when you come to this calculation and impact of working capital, it's great to have money owed to you, but you've got to finance it, and it's a trap. And I often kind of try to relate it back to if you were starting the business tomorrow. To explain it, you had nothing, but you sold $100,000 in month one. Well, you're going to have from day one, you're going to have expenses to pay and suppliers. So that's straight up. You might even be trading profitably, but you don't have any cash. So you need a facility to plug, pay the bills while you become more profitable. And as you say, as you grow, it gets higher and higher. And it's that shortfall. It's good to have. It's good in the sense you've got money owed, but if you can't get it or can't get it quickly enough, it cripples. It can cripple a business. Yeah. So Martin, in terms of we were chatting earlier about the bank feed, the raw data that comes out of the bank account, which in time becomes management accounts and then tax returns. But banks and others, fintechs are looking at that raw data. So how does an owner and their accountant or their bookkeepers, often the first port of call for producing interim management accounts? Interestingly, when I'm advising owners about the sale of their business, a valuation as at today, the raw management accounts are often the most important. Often mostly you're between financial years. So you might have the last finished return would be 6 months old or 12 months old even. So we go to the management accounts, and that's where you get a lot more detail about what a business is really all about, because by the time it gets to a tax return, all the stuff's rolled up into buckets, and it doesn't really tell you a great story. So it's vitally important information. So bookkeepers, accountants, owners, what can they do with that to help them better prepare for a credit application?
Well, I call this keeping the account clean. Often as people come to me, because like you said, I'm the place to go to when the banks have said no, the situation is they often are in a bit of a liquidity pinch. So, and that's reflected in their bank accounts. But the one other thing that's a black mark, which I still see today, is dishonoured payments. If you really want to some of the fintechs say, we'll accept no more than 2 dishonours in 6 months. Now, those dishonours can happen for a lot of reasons, and it's basically showing the business doesn't have enough liquidity. But it's about keeping your bank account clean. So don't let dishonours happen. So, don't make a payment when you don't have the funds. Talk to your suppliers, negotiate. There are ways you can get around this, but this is the first red flag. It's a red flag that the banks see when they're holding your trading information, or when someone else has a snapshot at your account. They have the same situation. They see that there's a problem, or just measuring sales. 3 months ago the sales were 100,000. This month they're only 50. What is going on here? It's not really rocket science to understand that. So that's why it's very important to look at putting in place credit limits and arrangements like the unsecured overdrafts before things get tight.
Yeah. When the going's good and you don't need it necessarily. Yeah.
There's a saying: the banks only lend money to people who don't really need it.
Yeah.
So when you need money, it's not the time to make an application. So that's a bit of the business planning cycle. I think people have got to look further down the track and open their planning cycles to see what their liquidity requirements are going to be.
Yeah. I think one of the other traps or failures is not really knowing what goes through your bank account necessarily. There's a lot of things that can go through, and over time direct debits, subscriptions, but also, I have been aware of, innocently or otherwise, not disclosing a lease or a regular payment for something, and that's that can catch you out in terms of an application, because what about this? And you say, I forgot about it, or I didn't.
I see that happening quite often, because people often forget about leases and a photocopier, and it can be all sorts of things.
Yeah.
And of course, they are all revealed when the analytics go across your trading account, because we're seeing this payment, and it might be to the photocopy company, but it's still it's a rental contract. It's a lease.
It's a commitment. Yeah, and I think this is the failing, and also the great opportunity with deriving a better financial return from your business is really understanding those numbers, and then using that data yourself. Forget about the banks just for a minute to change where you focus and how your business performs. If you really do go through and understand where it's spent, where it's coming in, and how it compares to last year, same period, it's a very telling sign. So we are talking about financing here to replace existing facilities or for growth, but 101 for any business owner is using those management accounts, if set up correctly and with the right chart of account, so it's good information. There's really, if you're going to grow your business or change the way you run your business, you've got to understand what the numbers tell you.
It's very, very important. So, and a well-informed business owner is a great client, because they know what's going on in their business, and you're not telling them, look, I'm noticing these issues that are going to become a problem as far as credit goes. And at this point, there are some interesting things that one can do with the new accounting systems. And let me use MyOb and Xero both have facilities to do this. But one of the things I do a lot of work in is in debtor and trade finance. And debtor finance is something that people will lend to you against the invoices that you have outstanding. In other words, that 200,000 owed by your customers. And trade finance works in the other direction, and that will provide the ability to pay your creditors. So that's lending you money to pay your bills, in simple terms. But with the new accounting systems now, debtor finance used to be a bit of a complex manual system. You had to run shadow ledgers and have banking details changed. Today, there are lenders that will simply look at your MYOB. They'll take a live feed from your MYOB and say, oh, look, you at any time have $200,000 worth of debtors. All right, we'll give you a overdraft type facility for 150 secured by those debtors. So you can, and that's a very simple system now, and using, the modern accounting processes and the live feeds from the bank account into MYOB or to Xero means that that asset can be assessed and lent against by a lender.
Right. So, yeah, look, it makes an awful lot of sense. Again, like game awareness. What assets do you have that you could finance, or where do you need facilities? Does that often bump up against their incumbent bank with their floating charge, or against all business assets, or is it just a bit of pre-planning needed to kind of start to unwind and untangle that?
The banks, like to have the residential property, and they like to have a charge over the business as well.
Yeah.
And like if we look, let's say mortgage rates at the moment are at 6.5%, 6%. Just depends where you are. If that mortgage is all of a sudden turned to business loan, then the banks add an extra 2 or 2.5 points on top of it. So business loans 8.5%. But it's secured by exactly the same thing as your mortgage. So, I have better problems understanding why that it's more expensive. But, yes, it can be an issue with floating charges over the business. That's part of that de-entangling. Or I've had situations, depending on what the assets of the business like, that the banks will allow a debtor funder to take a charge over the debtor book, but they'll keep their charge on the rest of the business.
Yeah, okay. All right. Yeah. So a lot of planning here and getting some assessment, some advice about how you're structured. What probably most importantly, what you might need going forward. Do you really need to tie up? I think it should be an objective for many owners to untangle that.
Yes, exactly.
It's how practical and how quickly, but it happens. I'm not sure, but it's when businesses get to, this is a challenge in the SME market. There are significant risks that can come from left field, and so you understand why a bank would want to have that cover, but where at what point do you cross over to the bank? The business has a track record. It's got some other financeable assets, so you strip away the cover everything kind of approach of having the house and the flooding charge to identifying specific assets or specific needs, and using this suite of fintechs around that specialise in all sorts of different lending. Martin, a couple of just quick examples of clients you've worked with recently, how it started, where they ended up, and what was the positive impact on them?
All right. Yeah. Well, look, I suppose the first one that's got a couple of interesting lessons. I had a line hole boring company in WA. And what they basically did, they had a couple of big trucks that would go out to the mining areas with metal lathes and all the stuff, all the machinery stuff you need to support operations. So they could do on-site maintenance to a dozer, for example. And here's an actual example. Their clients were BHP, Western Mining, all absolute blue chip clients. One of the problems they had is that they would go on site and the site foreman would say, "Oh, look, we've done the pin on the blade of this dozer." And they say, "Oh, look, we'll machine another pin now." But then their technicians would have a look and say, "Look, the pin on the other side of the dozer is going to go in 50 hours, we think." And, of course, the on-site foreman says, "Do both." However, what happens is when you're dealing with blue chips, they have very rigid processes, and you only have a purchase order to do one item, not two. Now, you were authorised in the field to do the second item, but that means, what do you do then? So one of the mistakes they initially made is they had a purchase order number 10, let's call it, and would put both items on it. And that would mean they didn't get paid for the first one or the second one while everybody in the accounts payable worked out or not. A rule for business is when you've got a purchase order and you have variations, send your first invoice that matches the purchase order and then argue about the variations later so you don't hold up that cash flow and those payments. Now, what also happened is that this was just before COVID, but they are an interesting example. But BHP, which was their main client, outsourced its payments to India. So not only we have time difference and all that complicated procedure, but they were waiting 90 days to get their funds. So generally anything over 90 is considered outside trading terms and in default, but because of who the clients were, we managed to put in a facility that would let them go to 90 days and gave them the liquidity they needed to grow the business. Recently they have sold that business at a substantial profit and have actually retired, and they're both about 40. So it was it was a good story, but just sometimes the mechanics of business can be a problem.
Yeah.
Perhaps another example is that sort of illustrates the cash gap that we were talking about earlier is I have a couple of clients that are in traffic management. So in traffic management, that means they're the guys that have got casual workers out there with a stop-go sign and a truck with all the signs that are laid out on all the roadworks. The problem they face is that they have to pay their casual workers every 7 days. Okay, so pay runs on Thursday and that's when it happens. However, their income from the builders or construction companies they're working with and so forth, they don't get paid till maybe 45 days. So they're a classic case, and this in their business it's labour, and you can't have terms on your labour, so they require things like debtor funding to give them the money to pay their staff when it's due, while they're waiting to get paid by their clients. And the other thing that has been very useful to one of those particular clients is that the receivable, in other words, the invoice is insured by the lender. So the lender has taken out insurance in case one of the companies you work for becomes insolvent. And in the construction industry, in the last couple of years, that's been very handy. My clients had over $100,000 in insurance claims, 3 different claims. And if they hadn't been insured, they're insured to 80% of the value. He would have possibly been in a lot of trouble when a major customer defaults on their payment and goes into administration. So there's some ways, and that's something that you don't necessarily have to use debtor finance, but judging the risk of your receivables, particularly when you have large customers, is a very important business strategy and something that you need to look very carefully at.
Yeah. So a lot of what you're saying, and it makes an awful lot of sense to me, is have some way of assessing where you're at. How entangled are you? How much of a negative is that for the business, and thinking forward to what you might need. So on that note, we've both used and are familiar with the term fintech. I'm not sure necessarily that all small business owners would understand what fintech is. However, my understanding is it's really technology and data driven lenders who can break down a business into component pieces and say we can lend against this, we can lend against that, and debtors, stock, would be examples. Plant and equipment would be another. So is that an okay definition of what a fintech is? Because there's an awful lot of these kind of lenders out there, and it seems to be mushrooming. And so I'd say that for many small business owners, there's a whole much bigger range of options to finance their business than they might be aware of.
Yes, and look, that is a fair definition. I suppose, as organisations, they're using data, and they use data, but they use their experience. They are very quick. Like, you can get a $200,000 overdraft in 48 hours. However, you've got to score. Right, so they take a bank account feed and run their analytics over that, and then they look, okay, this business is going well. How long is it? They use simple criteria because they're mass transaction type people. So they say business has been going 5 years, liquidity is good in the company, directors are asset backed. Let's do a deal.
Right. So they might validate that the directors have financial capacity, but aren't necessarily looking to take a mortgage or, but it gives them comfort that there's a business track record and a capability, financial capability of the owners and directors.
Yeah. One of the things is that, there's the C's of credit are capacity, collateral, character. And when you start looking at some of those, the character of the people, because they're doing unsecured lending, is important. And they don't necessarily need collateral, but they can see that you have the capacity because I've got a successful business person here who's bought a house and half paid it off. Those are other sorts of things that mean that all the boxes are ticked and it's easy to get access to that sort of credit.
Yeah, we discussed the 3 C's of credit with Ben Toshinsky from Judo Bank before Christmas, and as a relationship-driven traditional lender to small business, they're doing an outstanding job. A lot of ex-Big Four bankers in there, but they, I've had a lot of interaction with them, and they are very much on those 3 C's, and
yes.
maybe
and it's 4 C's depending on which way you define
4 C's. I was just
But I work with Judo, and I find them very good, but they still are. They're not quite a fintech. They're a bit like a banker because they will lock everything up. So that they are. But they are better, and I find them more flexible than the traditional banks.
Yeah, as a pound for pound comparison to a Big Four, timing wise, understanding, going out, stepping through the business. I think that I'm not here to promote Judo, but I know from a fairly significant number of interactions over the last few years that their business owners have been really happy with the options they've presented, timely and cost effective. But back to fintech. So, are you able to just break down reasonably quickly the range of different lending you might tap into, and then what we might do after that is just finish out with your contact details and a pit. Yeah.
Okay. Well, look, I suppose that the fintechs often move into particular niches. Like there's a company called Luca Money, and they're a relatively small fintech. But what they do is they provide trade finance. So they will give you an unsecured loan because they look at your MyOb accounting system and they see, once again, where you are, but they only lend you cash to pay your suppliers. So, but they'll say, oh, look, you've got a reasonable business. Their cost is really good value. And they'll say, oh, look, you qualify, you've got a $50,000 line of credit now with us. It's quite simple. So there's someone who will only do that on trade finance. And then we have, as I mentioned earlier, some people that only do that on debtor finance. Yeah. So some of those are fintechs, some are more traditional debtor lenders. And then we have a lot of nimble type fintechs that will do a mixture of things. So I particularly like a company called Shift. Shift does a lot of the unsecured overdrafts that I'm talking about, but Shift also have things like they'll take over your debtors for you. So say, for example, I've seen this happen a couple of times in construction. They say, well, instead of you lending your money, which is what you do with your debtors, we'll manage your entire debtor book. So anyone buys anything from you, they want terms, that's fine. We'll give them terms, but they sign our paperwork. So they make an assessment. So they're actually lenders that know what they're doing and can score a business and decide the risk, because often small business people don't quite understand the risk that they face in their debtor book.
And I imagine in that case also it's in a lot of small businesses you're chasing people or businesses that you're kind of friendly with, and so here you've got a third party, exactly. not a debt collector, but a debt manager. Take the emotion out of it. Yeah.
Because one of the problems is that generally the managing director of the business has been the guy who's led the sales of the business.
Yeah. Yep.
And secured all the big accounts, and he has lunch with his. And what happens is that there's a conflict of interest in a bigger organisation. Sales will go and sell something, and then the credit department decides whether they'll take it on. And they're two separate entities. But in a small business, we get a bit of a conflict of interest. Oh, Jack will be right. He'll pay us. He spoke to me. Next week should be fine. And you get caught up in that.
I think I really noticed that in the accounting profession. There's a lot of great accountants out there have debtor books that stretch into I'm sure there are other, but it was quite notable for me and in its personal relationships and they're very forgiving as accountants.
Yes, exactly. and they have the worst books. The only one I've seen that's worse is perhaps lawyers.
Right.
Who do litigation.
Yeah.
They often, and particularly those who work in family law, because they're waiting for all the settlements and sales, and they have fees outstanding for a year.
It is event. It's in some part they're event driven, but because you got to wait for a ruling. In closing, you are who you call when the banks say no. So just a quick recap on what you do and how people get a hold of you if they want to chat about an alternative financing arrangement.
Right. Well, what I do is, as I said, I'm a working capital strategist. So I help people with their debtor and creditors and their processes a little bit, not just the lending, because in order to achieve the right outcome, sometimes you have to look at how you manage your debtors and how you manage your creditors and look at some changes. What I do is use different sources, different lenders to give businesses more liquidity so they can grow. So it's really about getting money into the business. And look, it may not always be the cheapest money, but it's the money that's available at the time. And then you make commercial decisions knowing what your cost of funds are to what I do with those funds. And that's where I talk with business owners. Look, I suppose I'm a bit like an old-fashioned bank manager. And
you've got a big desk?
No, I haven't got a big desk. I go and see my clients.
And walk around.
Walk around. Now the banks send out graduates that are wet behind the ears, and they're 22 years of age. It's not someone that, I can sit down and talk to a business. Oh, what are you doing marketing-wise? How are sales at the moment? It's not just about a balance sheet thing, because then you get to assess and see what a business wants to do and get some understanding of where they want to go. Yeah. And that way you can use your IP and experience to say, well, we can use this funding to achieve that outcome for you.
Yeah. And I think, underpinning that is a getting to know the owner and what they're aspiring to do in their business. And if it's in a phasing down, that's fine. You might, just want to pay down debt and be done with it. But, for growth-orientated businesses and, not only younger businesses, but those, with a real opportunity to grow, you got to look. It's like a lot of things that owners need to do. It's very easy for us to sit here and say you should exit plan, you should restructure your finances, you should get better systems. But we'll keep saying it because it's all true, and you got to find time and also I think just take a bit of a break. So every now and again think about what you want to do with your business. But funding is the lifeblood of a lot of them. So how do they get a hold of you, Martin, if they want to check?
I have a website called finforbiz, finforbiz.com.au. Or the other thing is I'm a bit old-fashioned myself. I don't mind a phone call.
All right.
We'll put that like a conversation.
Yeah. I well understand and agree with you. What I'll do is I'll put the number in the show notes and people can follow you from there. Thanks so much for your time today, Martin. Practical as I expected and from a base of a lot of experience. So I'm sure that'll be really well received and helpful for those listening.
Yeah, look, thank you very much, Michael, for the opportunity because, the job is to educate businesses about what's available for them. So discussions like this and giving them some information is at least some food for thought because quite often they're so busy working away. Something like a podcast, and that's a great way to digest some information while you're still typing out the accounts or banging your hammers or whatever you're doing.
Yeah, yeah. No, there's no end of things for owners to do, and we both and all, lots of people understand that, but we've got to keep hammering away. In lending, as one example, there's a lot more opportunity to diversify and your lending than there has been for a long time, and so you got to put your head up and as you say, prepare a bit. It's not as simple as just getting the finance. You got to have the workflows and systems, and that takes a bit of effort. But like everything, if you do it well, there's a return. All right, Martin, thanks so much for your time today. You take care. Well, I hope you enjoyed that episode of Small Business Banter, and I hope it was helpful in you getting the most out of your small business ownership. To subscribe or listen back, or to check out any of the resources or information we talked about today, head over to the website smallbusinessbanter.com.au, or if you want, search up Small Business Banter on your favourite podcast player. Don't forget to subscribe, and if it was really helpful, I'd love it if you told another business owner about the podcast. If you thought it was exceptionally helpful, then how about you leave me a 5-star rating? If you think I can help personally, please reach out to me, Michael Kerr, via the website. There's a new episode out every couple of weeks. We'll catch up then.